Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. Hello, everyone, and welcome back. Today, we're taking a closer look at a real giant in the tech world, Taiwan Semiconductor Manufacturing Co., Ltd., TSMC. We've got their latest numbers, the Q2 2025 results, plus what they're saying about the future. Our goal here is really to cut through the noise and give you the essential insights, help you get up to speed fast on this absolutely critical player.
Exactly. And TSMC's performance, it's really more than just one company's story, isn't it? Given their foundational role in making chips for, well, almost everyone, their outlook is a huge signal for broader tech trends, even the economy. So yeah, we'll aim to deliver the most impactful stuff from their recent earnings call, IQ2 2025 financial performance. Solid quarter.
Okay, let's jump right into the Q2 2025 numbers. And it was a very solid quarter for them. Revenue hit $30.1 billion US. That was actually above their own guidance.
Yeah, up quite a bit sequentially, about 17.8% in US dollar terms.
And the gross margin landed at 58.6%. That was a tiny dip from the previous quarter, just zero point 0.2 points. But interestingly, the operating margin actually ticked up to 49.6%.
That's right, up 1.1 percentage points, just some pretty good cost control there.
And the bottom line for investors, EPS, earnings per share, was TWD 15.36. That's up a massive 60.7% compared to last year.
It really highlights their leverage. Now, digging into what drove those numbers, it was clearly strong demand for their latest tech, the 3-nanometer and 5-nanometer nodes. That really pushed things up. But they did mention facing some headwinds from unfavorable foreign exchange rates.
Right, the currency impact.
Yeah, exactly. But higher factory usage, capacity utilization, and their cost improvement efforts managed to offset some of that. So good operational execution.
Let's look at the technology mix then. This is always fascinating with TSMC. 3-nanometer tech brought in 24% of their wafer revenue.
A big chunk.
And 5-nanometer was even bigger, 36%.
Wow.
Then 7-nanometer added another 14%. So if you add that up, their advanced technologies, so that's 7-nanometer and anything smaller, accounted for, 74% of their total wafer revenue?
74%. That really shows you where the value is concentrated, doesn't it?
Yeah.
It's all about the leading edge. And connecting that to the platforms they serve, high-performance compute, HPC, it just surged, up 14% quarter over quarter. It now makes up 60% of their total revenue. 60%.
60% from HPC. That's huge. Smartphones.
Smartphones were up too by 7%, now at 27% of revenue. But, that HPC dominance, it really signals TSMC's strong position in AI and data centers. That's clearly the major growth engine right now. 2, financial health and capital planning.
Okay, let's shift gears slightly to their financial health. Balance sheet cash flow. Looking pretty strong there, too.
Very strong. They finished Q2 with about TWD 2.6 trillion, that's roughly $90 billion US, in cash and marketable securities, a very comfortable cushion.
And operationally efficient, too, it seems. Accounts receivable days went down.
Well, actually, accounts receivable turnover days decreased by 5 to 23 days. They said that was mainly due to NT dollar appreciation affecting the calculation, not slower payments.
Okay. Got it. And inventory.
Inventory days decreased quite a bit, down 7 days to 76 days. And that was due to higher shipments, particularly those N3 and N5 wafers moving out the door quickly.
So strong demand, pulling inventory down. Makes sense. And cash flow generation.
Very healthy. They generated almost TWD 500 billion from operations in the quarter. They spent a good chunk, TWD 297 billion, on CapEx, building future capacity.
Which is about 9.6 billion US, roughly.
Right. And they also paid out TWD 117 billion in cash dividends to shareholders. Even with all that spending, their cash position is solid. The slight dip in the total cash balance was, again, largely down to those unfavorable exchange rates impacting the valuation.
Okay, so financially robust. What about the outlook then? What are they guiding for Q3?
They're projecting Q3 revenue between $31.8 billion and $33 billion US. At the midpoint, that's about an 8% sequential increase and a very strong 38% jump compared to Q3 last year.
38% year over year. Still very strong growth. And margins.
Margins are expected to dip a bit in Q3. Gross margin guidance is 55.5% to 57.5%, and operating margin between 45.5% and 47.5%. We'll get into why in a moment.
And crucially, what about their spending plans for the full year? The capital budget.
They're holding that steady. Still guiding for $38 billion to $42 billion for the full year 2025. So no change there. Still investing heavily for the future. 3, navigating profitability. FX and overseas expansion.
Okay, let's unpack this margin picture then. You mentioned Q3 margins dipping, and Q2 gross margins saw that tiny sequential dip too.
Yes.
This was primarily due to, well, two things. That unfavorable foreign exchange rate we talked about,
Yes.
and also margin dilution starting from their overseas fabs.
Right. And that currency impact, it's really quite significant. They quantify it. A 1% appreciation of the Taiwan dollar against the US dollar shaves off about 40 basis points, or 0.4 percentage points, from their gross margin.
40 basis points for every 1% move.
Wow. Yeah. And in Q2, the NT dollar appreciation hit their revenue by about 4.4%, and their gross margin by around 180 basis points.
That's almost 2 full percentage points just from FX.
Exactly. And for Q3, they're expecting an even bigger hit because the NT dollar is projected to appreciate further, maybe around 6.6%. That's expected to reduce Q3 revenue by 6.6% and gross margin by about 260 basis points. Almost 3 percentage points.
So that explains a big part of the Q3 margin guidance dip. It's a major headwind they just have to navigate.
Absolutely. It's structural for now. And then there's the other factor.
The overseas fabs, Arizona starting up.
Yes. They explicitly said the margin dilution from the Arizona fab started in Q2. It impacted gross margin by over 100 basis points, so more than 1 percentage point already.
Just from Arizona phase 1 ramping.
Right. And for Q3, they expect that dilution to be more pronounced. You'll have continued ramp in Arizona, plus the Kumamoto fab in Japan starting its ramp. So you get a double effect there.
And is this dilution a temporary thing, or?
Well, they gave some longer-term perspective. They see this overseas fab dilution as being around 2% to 3% annually in the early stages, and potentially widening to 3% to 4% annually in the later stages over the next 5 years, starting from 2025.
So a multi-year structural cost increase from going global.
Pretty much. It's the cost of geographic diversification and serving customers locally, but, and this is important, they also stress they're working hard to improve cost structures overseas, working with suppliers, working with customers on value sharing. And despite these headwinds, the FX and the overseas dilution, they reiterated their confidence in achieving their long-term gross margin target of 53% and higher.
If these costs are structural.
By leaning on the things they can control. Technology leadership, getting value pricing for that leadership, operational efficiencies, capacity utilization. It's a balancing act, but they believe they can manage it. FORFI, demand outlook and global footprint.
Okay, so profitability pressures are clear, but let's get back to the driver.
Yeah.
Demand. This is where it gets really interesting, right? The CEO basically said Q2 revenue beat their forecast because AI and HPC demand was just so robust.
Yeah, incredibly strong.
And looking ahead to Q3, it's the same story driven by leading-edge tech demand. They haven't seen any change in customer behavior for the second half of the year.
That's the headline. Now, there are some nuances they mentioned, too. There's still some uncertainty around potential tariff policies, especially how that might hit consumer electronics.
Right, the macro picture isn't perfect.
Yeah, exactly. And they noted some rebate programs in China might be pulling in some short-term demand, but they don't see that as sustainable. Overall, non-AI markets are still expected to recover, but maybe mildly. But the core message was, the fundamental demand for semiconductors, especially for AI, is incredibly strong.
Including this sovereign AI concept.
Yeah, that's a growing trend. Countries wanting to build their own AI capabilities, which means buying lots of high-end chips, it adds another layer of demand.
And all this strong demand led them to update their full-year forecast for 2025.
It did. They revised it upwards, now expecting around a 30% increase in revenue for the full year in U.S. dollar terms.
30% growth for the year. That's a powerful signal.
Absolutely. Driven mainly by 3 nanometer, 5 nanometer, and that booming HPC platform we talked about.
Which leads us nicely into their global manufacturing footprint plans. They're spending billions, expanding everywhere, it seems.
It's a massive undertaking, and their decisions on where to build overseas aren't random. It's based on customer needs, wanting geographic diversification for supply chains, and, critically, government support and incentives.
Let's break it down. The U.S., Arizona. And that sounds huge.
It is. Total investment plan there is $165 billion. That's not just one fab. It's for 6 advanced wafer fabs eventually, 2 advanced packaging fabs, and a big R&D center. They call it a gigafab cluster.
6 fabs in Arizona.
Yeah. The first one, making N4 chips, actually started high-volume production late last year, and they said yields are comparable to Taiwan already.
Impressive.
The second fab, for 3 nanometer, the building is complete, and they're actually speeding up plans to get it producing because customer demand is so strong.
Speeding up N3 in Arizona.
Yes. And construction for the third fab, that's for 2 nanometer and even A16 tech has already begun. They're even looking at speeding that up too. And then fabs 4, 5, and 6 will follow for N2, A16, and even more advanced nodes based on customer demand. The goal is to have about 30% of their 2 nanometer and beyond capacity located in Arizona eventually. It's a major strategic shift.
Okay, that's the U.S. What about Japan?
Japan in Kumamoto. That's focused more on specialty technologies. The first fab there also started volume production late last year, focusing on things like CMOS image sensors, good
Yeah.
yields, strong government support, and they plan to start construction on a second specialty fab in Japan later this year.
And Europe? Germany.
Dresden, Germany. That's also progressing smoothly, again, focused on specialty tech, particularly for the automotive industry. Strong government commitment there as well.
But they're not abandoning Taiwan, right?
Yeah. Oh, absolutely not. Taiwan remains the core. They're continuing massive investments there. Plans for 11 more wafer fabs and 4 advanced packaging facilities in Taiwan, including multiple 2 nanometer fabs in Hsinchu and Kaohsiung. It's still the heart of their R&D and high-volume advanced manufacturing.
So what does this all mean, this huge global build-out?
It's their strategy to remain the trusted tech and capacity provider globally, offer geographic options, build resilience, serve customers where they are, all while aiming for profitable growth. It's a complex balancing act, but essential for their future. V Advanced Technology Roadmap, N2, A16, A14.
Let's pivot to the future tech then. Beyond 3 nanometer, they talked a lot about N2 and A16.
Yes, the next big waves. N2 is their next full node after N3. It promises significant improvements, 10 to 15% faster speed at the same power, or 20 to 30% lower power at the same speed, plus higher density.
Key for AI and mobile. When does N2 arrive?
On track for volume production in the second half of 2025, so next year. They expect the ramp-up profile to be strong, similar to N3. And there's already an enhancement planned. N2P, that's N2 Performance, scheduled for volume production in the second half of 2026.
Okay, N2 and N3. Then they talked about A16. What's A stand for?
A seems to stand for Angstrom-era technology. A16 is particularly exciting because it introduces a new feature called Super Power Rail.
Super power rail.
Sounds fancy. It's a backside power delivery network. Basically, it helps deliver power more efficiently to the transistors. This gives A16 another boost on top of the transistor improvements. 8 to 10% more speed, or 15 to 20% less power compared to N2P, plus a density gain.
And who needs that extra efficiency?
It's particularly beneficial for high-performance computing chips, things with really complex wiring and high power demands. Think big AI accelerators.
Yeah, and A16 production.
Also on track for the second half of 2026. So N2P and A16 hitting around the same time frame, likely targeting different types of chips.
And they even looked beyond A16 to A14.
They did. A14 will use their second generation of nanosheet transistors. That's the next evolution after the FinFETs used today. It promises another big jump, 10 to 15% more speed, or 20 to 30% less power compared to N2, and around 20% better density.
And timing for A14.
Development is on track for volume production starting in 2028, and they plan an A14 version with Super Power Rail for 2029.
So a clear roadmap laid out for years ahead.
Absolutely. N2, N2P, A16, A14. They expect these to be large, long-lasting technology nodes. It's their strategy to keep extending that technology lead and capture growth, especially in energy-efficient computing, which is becoming so critical. 6. Key insights from the Q&A session.
Okay, before we wrap up, let's touch on the Q&A session from the call. Analyst questions often bring out some really interesting details. What were some of the key takeaways for you from that part?
Yeah, the Q&A was insightful. Several themes stood out. First, AI demand and CoWoS capacity. They were pushed hard on this. The message was clear. AI demand is just getting stronger and stronger, especially for CoWoS, that advanced packaging needed for AI chips.
The bottleneck everyone talks about.
Exactly. And they used interesting phrasing. They said they're working to narrow the gap between demand and supply, not achieve balance, which implies demand is still running well ahead of what they can make.
Still chasing demand.
Pretty much. They also see growing momentum for AI on devices, phones, PCs. Chip sizes are increasing there, maybe 5–10%, and they anticipate a potential explosion in that market in the next 6 to 12 months.
Interesting. What about the near-term financial outlook? Anything more on Q4?
Yes, the fourth quarter outlook. Their guidance implies a potential sequential decline in Q4 compared to Q3. They acknowledge this reflects some conservatism, factoring in those potential tariff impacts and other uncertainties we mentioned. But they also said they expect to hit their high-end targets if the opportunities are there. So cautious, but ready to deliver if demand holds.
And looking further out to 2026 margins and pricing.
Big focus there. The 2026 gross margin and pricing discussion really highlighted the FX pressure. They emphasized they need to earn their value through wafer pricing in 2026 to offset those structural cost increases, FX overseas fabs. But they remain confident, repeating the 53% and higher long-term gross margin goal. Pricing power is key to achieving that.
Makes sense. Did they comment on specific customer situations, like the reports about H20 chips potentially shipping to China?
They did. On the H20 chip to China question, they said while they've seen the news reports, they haven't yet seen signals that would cause them to revise their own forecast for AI accelerator growth, which they still see growing at a mid-40s compound annual growth rate. They view it as potentially positive news for their customers and thus for TSMC, but it's too early to quantify any impact.
Okay. What about the ramp of the new N2 node? How does its contribution compare to N3?
Good question. For the N2 ramp and revenue contribution, they said the ramp profile itself, like the speed of bringing up volume, will be similar to N3. That's mainly due to capacity constraints. They can only build it so fast. However, the revenue contribution from N2 is expected to be bigger than N3's was at a similar stage, simply because the pricing for N2 will be higher.
Higher value node. And what about current nodes, N5 and N3? Still tight.
Very much so. On N5 and N3 supply demand, they said capacity for both is very tight right now and expected to stay that way for a couple of years.
Wow, a couple of years of tightness.
Yeah, but this is where their gigafab cluster strategy helps. They have flexibility to convert some capacity, like N7 lines to N5 or N5 lines to N3, to help alleviate bottlenecks where possible. But overall, all leading-edge nodes, 7 nanometer and below, are currently very tight.
Did they touch on using AI internally? You mentioned the productivity gains.
Yes, briefly on AI benefits and operations. They confirmed they use AI extensively in manufacturing and R&D, and they put that number on it. A 1% productivity gain for a company TSMC's size could be worth $1 billion. Shows the scale.
Incredible. So overall, capacity and spending plans, still full speed ahead.
Basically, yes. On overall capacity and CapEx, the demand picture for N3, N5, and the upcoming N2 is just unprecedented. They're working very hard to narrow the gap between that demand and their supply. The CapEx spending, that $42 billion, is all about funding future growth. So they don't expect CapEx dollars to drop significantly anytime soon, although capital intensity might not rise as much if revenue growth can outpace the CapEx growth.
And the return on that N2 investment should be good.
They expect N2 return on investment to be strong. They actually said they expect N2 profitability to be better than N3 and get back to the old days of profitability levels, all while considering that new baseline corporate gross margin target of over 53%. So N2 should be a very profitable node for them.
What about packaging? CoWoS is key, but any other strategies?
Their advanced packaging strategy is driven by customer needs. They offer a variety of solutions beyond CoWoS. These solutions are closely related to their leading-edge chip technologies, so there are synergies they can leverage.
And mature nodes. Is there overcapacity there, like in the rest of the industry?
That's where their mature node strategy differs. They focus on specialty technologies at mature nodes, things like radio frequency chips, image sensors, high-voltage components. These are driven by specific customer needs, often long-term contracts, differentiating them from the commodity memory or logic-facing overcapacity elsewhere. This explains the investments in Japan for image sensors and Germany for automotive chips. Those are specialty plays.
Interesting distinction. Any really futuristic stuff discussed? Humanoid robots.
They got asked about humanoid robots. The view was, it's too early to be a big driver in 2025 or 2026. The tech is super complex, integrating sensors, CPUs, AI, plus extreme safety requirements since they interact with humans. But long term, they see big plus potential, maybe even bigger than the electric vehicle market eventually. A very long-term view, though.
Fascinating. One more. Any sign of customers trying to pull orders forward to get ahead of potential 2026 price increases?
No, they said no signs of demand pull-in ahead of 2026 pricing, primarily because capacity is so tight already, and the manufacturing cycle times are long, especially for leading edge like 3 nanometer, around 4 months. It's just not feasible for customers to pull in significant volume.
Okay. And you mentioned AI moving faster to the leading edge.
Yes, the AI adoption of leading edge. Historically, AI might have used slightly older nodes, but the intense focus on power efficiency in data centers is pushing AI accelerators to adopt the absolute leading edge, like A16, much faster. That potential 15–20% power saving is a huge deal for data center operators.
That makes sense. Last point from the Q&A, the pace of overseas expansion. Is it driven purely by demand, or do things like U.S. government incentives, ITC, play a big role in, say, accelerating the second Arizona fab?
On overseas expansion pace and dilution, they were clear. The acceleration of the second U.S. fab is driven primarily by customer demand, full stop. The U.S. Investment Tax Credit, ITC, helps financially, of course, but it's not the main driver for the timing. The ITC's positive impact on margins also gets amortized over time. It's not a sudden boost. And they reiterated that the U.S. leading-edge investments don't impact their specialty fab plans in Japan or Germany. Those serve totally different markets and customer needs. Outro.
Wow. Okay, so we've really covered a lot of ground there on TSMC. It's clear they had a strong Q2, fueled by that incredible AI and HPC demand.
Hmm.
They're navigating some real headwinds like currency and the cost of building factories worldwide, but seem strategically focused on managing those.
Yeah, while keeping that long-term 53% plus gross margin target in sight.
And their investment in the future, N2, A16, A14, plus the massive global footprint, really solidifies their position as, well, the foundation for so much of the tech world's future. Understanding these details, really does give you a much clearer picture of what's happening.
Absolutely. And maybe a final thought for everyone listening. Given this aggressive global expansion by TSMC and this seemingly endless demand for more and more powerful yet energy efficient computing, what does that really imply for global tech supply chains over the next decade? And for economic development in places like Arizona, Japan, Germany, it's about more than just chips, isn't it? It's shaping the future of industries, maybe even geopolitics. TSMC is right at the center of it all.
A lot to think about there. Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.